Hi everyone, welcome back to the Advanced Mortgage Solutions podcast. I'm Joel Sadler, your host, and our expert today is Scott Miller from Advanced Mortgage Solutions. Welcome, Scott.
Joel.
Today, Scott's going to talk to us about interest rates. Interest rates is a hot topic, always a hot topic, but there's been a bit of news recently in the last 24 hours. Today, by the way, is the 30th of January 2026. There's been a wee bit of news about some major banks increasing long-term interest rates. So, Scott, do you want to provide some comments on that and where you think things are going to go or what people should consider at the moment?
Sure. So, look, not a lot of people really know in New Zealand that a lot of the funding that's required for mortgages is sourced, the funds are sourced from overseas. So what that means is, although the official cash rate might not change in New Zealand at all, you're finding all of a sudden, particularly those longer term rates, are changing without a change domestically. And that's because, we just alluded to off air here, that the Fed decided not to do any changes this time round in their, they don't call it the official cash rate announcement, but their version of that. They've held their rates where they are, despite a lot of pressure from the incumbent government of the day. I think there's some rather nasty letters going back and forth between those two institutions if you're watching it. But ultimately, central banks should be separate from politics. And run the country's ability to set interest rates independent of political sort of aspirations or pressure. And that's certainly borne out in the latest result out of America. And what that then turns into in New Zealand is, because we do fund so much of our money for mortgages from overseas, is that we're sort of on the whim of the markets a little. And although our cash rate has stayed unchanged, the Fed's sort of reserve by saying, hey, we're not going to do anything, has just pushed those cash wholesale rates a little higher, particularly on the longer term rates, those 3, 4 and 5 year rates. And that means that the banks can't buy that rate at the same amount anymore. So they're forced to still make their margins, put up the interest rates domestically. And that's what you're seeing just the start of at the moment in New Zealand. I don't know how long that's going to last, because the world economy, and I think we've touched on this a couple of times, is still fairly well in trouble. It's not all roses out there by any means, and the cost of living that we've gone through in New Zealand, I should say, and just seem to be sort of getting out the other end of that with employment figures coming right again and their numbers of jobs being offered are sort of recovering a little bit. The world hasn't really nowhere near that far through that process, so I don't know that we're going to see a long-term period of increasing interest rates. I don't see that happening. I see this as more of a little bit of a blip at the beginning of the year. And then I don't think a lot else is going to happen through this year until maybe the end of the year. And you may find, when there is a change at one of the reserve banks around the world, that money will become cheaper again. There is that option happening. It's just we're in the perfect storm of sort of not knowing, I suppose. But we're sort of encouraging people to split their loans over, either a 6-month term or a 4 or 5 year term, depending on how aggressive they are or how risk adverse they are to changes in the size of their repayments. Particularly if they've got larger loans, they're affected by percentage changes. So those sort of conversations are ones that we have every day with our customers.
And so that 6-month fixing is making a bet that interest rates are going to come back down again and then fix for a longer term. Or as you've said before, if you go for a longer term, you're looking to lock in the current rate. And hopefully that's coming down the other side of any interest rate rises that might unfold. Is that the sort of
so that's where, like right now, sort of the 2 and 3 year rates not really that attractive, because you'd probably come out for renewal at the time that rates were still increasing. Three, you might find the top. At least 4 and 5, you're going to ride the curve down the other side of rates going down again. Well, that's the hope. You can only work with the information that you have at the day, but that's certainly responsible thinking, if you like. And funnily enough, as much as you've seen, those longer term rates just tick up, Westpac today's announced a reduction in the 6-month rate by 0.2%. So, that's now down at that 4.49%, which is the same as what they're offering for 1 year. So it does make that 6-month rate quite attractive. But again, it depends. I mean, if you're selling your house in 6 months' time, wow, have you just been given the best interest rate ever? Fix it in for that 4.49, sell your house in 6 months, hello, But
Yeah.
then again, again, if you're not thinking of selling and you are risk adverse and maybe the loan's a bit bigger, splitting the loan may be an option, or looking at those longer term rates would be something that would be viable for sure.
Yeah, and look, one of the recent podcasts last month asked you the question about, if someone was, had received an email from the bank saying, "Hey, look, you're due to refix in March." That was 3 months ago at the time. Now it's sort of 2 months ago. Um, the part I forgot to ask you was if someone, replies or logs into their bank, and chooses a certain rate today, which is the 30th of January, that's contractually locked in now. So even though the rates might go up or go down in that 2 month period leading up into March, will they change it on you, sort of thing? How does that part
It's a
work?
really good point. So
Hmm.
up until about a year ago, maybe a couple of years ago, once you fix that rate, that was it. You've locked it in. Sorry, if you want to break it, there could
Yeah.
be break fees, all those sorts of things. There's now a
Hmm.
softening around that, and I think it was pressure from the Reserve Bank to say to the banks, "Hey, you've got to be a bit fairer around that. If a client's picked a rate, and in the time between they pick the rate and the loan's actually rolling over, rates drop,
Yeah.
then you've sort of got to give them some kind of access to that lower rate." So, for example,
Right.
a lot of the banks just now have a simple $30 fee, and you can now get that lower rate that you didn't know was coming because you're fixed here. This is when it rolls over, and the lower rates come in the middle there. A simple little
Yeah.
$30 fee that's going to save you hundreds of dollars in interest repayments is
Yeah.
obviously something that's
Yeah.
really attractive. And that's the end of the cost. It's also the end of the
Right.
conversation. Yes, of course, you can do that, sir, madam, come this way, and it
Yep.
all gets actioned. So that's
Right.
really become a lot friendlier than it used to be. I suppose one of the things I
Yeah.
will say is that the banks are driving people more and more to do things on their app. The problem with the apps at the
Yes.
moment is that they're not overly sophisticated. So, yes, they'll let you increase your repayments, and they'll let you pick a rate. But what they won't do is they won't let you do a lump payment yet. Some of them, most of them won't. They won't let you split the loan and then put one part of the loan over this rate and one part over that rate yet. They've all promised us that the new apps are going to come out and those things are going to come available, but they just haven't quite materialized yet. So be very
Yeah.
careful if you want to do any kind of restructuring or anything a little bit more sophisticated than just picking a term and increasing the amount that you want to repay. Then talk to your financial advisor first, because that can lock you
Yeah.
out of them going to make
Right.
those changes in the background. Yeah.
Okay, that makes sense. So that's obviously if the rate comes down. So I can't imagine the bank would reach out and say to you, "Oh, by the way, your rate, your 6 month rate that you've
They
suggested has
simply
come
don't have
down by
time,
another
Joel.
point 0.2 points."
Yeah, they
No, no.
simply
So
don't
so
have
you have to
time,
be
Joel.
proactive and check it
100%.
yourself, right?
You have to
Yeah.
be
Yeah.
yourself. Yeah, look, banks don't have enough
Yeah.
time to look in the rear vision mirror for everyone that they have on their books. So it's
Yeah.
very much up to the individual to realise that they could now get a cheaper rate. The loan hasn't actually rolled over. So then they can have that
Mm.
ability of grabbing that new rate. Yeah, good point. Very good
Wow.
point.
Wow,
Yeah.
interesting. And then conversely or inversely to that, if the rate goes up, do they then have the right to come back and go, "Hey, your rate's going up. Sorry,
Yeah,
buddy."
no, no, because you have
Right,
physically booked in that rate at the rate of the
right.
day, and that
Yeah,
immediately gets held. And
yeah,
that's why, initially, so some years ago, there were some quite big break fees to break it because you wanted to change your mind, because now there was a perceived loss. You told us to book that rate in, so we booked
yeah,
it in. Now we're
yeah,
making a loss because
yep,
and that was what got found to be quite unfair, I think, through the Reserve Bank or the
right.
Commerce Commission or whoever made that decision and sort of told the banks, hey, let's be a bit fairer around this. Yeah,
Yeah, interesting.
yeah,
Interesting. Yeah, a side note on those sort of Fed rates, I've got a few friends or acquaintances that I don't know if you've heard of Polymarket, which is this online betting um, market where you can place bets, for example, on is the Fed going to reduce the rate
I
in
see.
January, February, March, or June,
Yeah,
and what are the odds, and so but a lot of people it's quite interesting when you go and read onto that. A lot of people are talking about that there is immense political pressure on the Fed to reduce, but they're digging their toes in. But also there is financial pressure with the bond market and all these sort of things, and that they're kicking the can down the road a bit. So it'd be quite interesting. I kind of tend to sort of agree with you at the moment. So it seems to be a little bit of a blip, whereas I think
yeah.
they may start to reduce again in in time. It's not doesn't seem to be urgent, but it's quite a bit going on, isn't there?
Yeah, and look,
Mm,
America's going into that stage of the unemployment rate starting to rise. From a political platform, that's never a good thing, right? So
mm,
that also sort of tries to, from a political point of view, let's suggest or persuade, their central bank to lower rates to try to stimulate the economy.
yeah,
Get some domestic spending back in and jobs back up, and all of those sorts
yeah,
of things.
yeah. Midterms around the
Yeah,
corner,
but
Yep.
like our Reserve Bank, the Fed's
Mm,
been set a margin. We want growth between this and this. We don't want it to go above this or below that. So that's
yep.
their mandate. And so,
Right,
they
right.
have to be independent of any other force, really, to make sure that they're
Yeah,
meeting the mandate that they're set out to do. So
right.
I agree. The government should have the ability to say, hey, we really want you to lower rates, but it's equally as much for the central bank to turn around and say, well, thanks for your point of view, but we've got our own mandate
Yeah,
that we have to, meet.
yeah.
So
Yes.
on we go, and that's
Yeah,
that's
yeah,
very much what's happened this time round, despite an immense amount of pressure to lower those rates.
yeah. Yeah. Interesting. All right, Scott. Well, look, thanks so much for the commentary on interest rates. It's really good advice. There's a lot of different factors to weigh up. I think these conversations are quite powerful for people to listen to and kind of weigh up what they want to do. So if someone wants to get hold of you, Scott, and talk about this type of thing, how do they do it?
Look, the reason for setting up this channel and having the conversations that we do, Joel, is really it's to give information to the public in a generalised form. So I'm not saying
Mm,
only contact me. Contact your financial
mm.
advisor to get their thoughts around how best to set up or continue with your loan. I mean, obviously, ring me if you want to, or email me. I'm always
Yeah.
open for business, but having sort of the little group community down at the pub and you're sort of getting advice from people who might have had a few beers is probably not the best
Yep.
idea if you've got hundreds of thousands of dollars on the table, and that's where going back to your financial advisor is just such a good idea. But if you want to contact me, obviously that would be at Advanced Mortgage Solutions website. There's all sorts of contact forms and information that we can give you around refixing, or of course you can call us personally and we'll help you through that process as well.
That's awesome for our listeners and our watchers. That's www.advancedmortgagesolutions.co.nz. Thanks,
So
Scott. We'll see you
awesome.
on the next episode.
Okay,
Cheers.
lovely. Bye.
Bye.